Ready to elevate your credit understanding and score? With insider tips and a plan, you can take action to improving your score, which can save thousands in unnecessary finance charges. Let's tackle today's topic with your coach, Credit Kristi.
Hey friends, it's Kristi, your credit coach. Thank you so much for joining me for another episode, and Happy New Year to you. It is the turn of 2024, and I just have wild expectance for an incredible year ahead of us, for you and for me. I just realized it has been a hot minute since I recorded and uploaded a podcast. The last one was, nearly 2 months ago, and I apologize for checking out. There's been a lot of change in my life. I moved companies, and you know how the holidays are, just being stretched to the gild with gatherings and celebrations. So I'm so glad to be back with you. Well, let's start this new year off with a couple of things that might be the obvious and a few things I'd like to share with you that perhaps you had no idea the impact financially that a lower credit score can have on your monthly cash flow and outflow. So a few things. In the month of January, we start receiving those credit card bills from all of our fun and gifting that we had experienced the month before. And the problem is not only this larger balance that you get to pay back, but having a higher utilization of what credit is available to you can really cause your credit scores to suffer. So if you are seeing your credit scores going down, a good possibility is because your credit card balances have gone up. Remember, the goal is to have 30% or less in terms of your balance versus your credit limit. So let's jump into what happens when your credit score is lower than where you'd like for it to be. Well, the simple way to explain it is you will pay a tremendous more in interest charges and fees over your lifetime than if you have a higher credit score. Now, you are so much more than your credit score. I don't mean for it to be something that suggests it's what you are or who you are, but it is an identifier. And when you are applying for credit, those decision makers use your credit profile, your credit score, your credit history as a way to determine if you are a greater risk or not. A lower credit score presents a larger risk. But what does this translate into your life if you have a lower credit score? Well, let me break it down for you now. A perfect credit score is now 780 or higher, and the algorithm can actually have your credit score go up to 850. I don't know that I've ever seen a true 850, but I have seen many credit scores over 800, and quite frankly, it's not very easy to do. There are a lot of factors, and it usually takes a long period of time to establish that kind of credit history. But 780 or higher is perfect on paper. This means you're going to get the very best interest rates possible. Now, if you're shopping for a new car, a lot of auto dealerships through their own company financing is offering tremendously low and very attractive interest rates. I've seen anywhere from 0%, 1.49, 2.49 because they need to move that auto inventory. So those financing companies are actually taking a loss on the financing to help move that inventory. But traditionally speaking, while we're on the topic of cars, if you don't have those special financing offers that you're seeing where some of those cars are wanting to really move their inventory, you might see that a new car loan will probably start somewhere in the 5 or 6% interest range. And on a used car, those interest rates tend to be a little bit higher. Well, I just visited nerdwallet.com, and they have an article called 7 Bad Credit Auto Loans of 2024. And this is a little bit of advertising for a few different companies, but if you scroll down through the article, it does have a nice spreadsheet that shows the different categories of how credit scores are typically profiled. So you have super prime, which is 781 to 850. That's the perfect on paper, people. Then you've got your prime, which tends to be where a lot of people fit, which is a score of 661 to 780. Then you have your non-prime, 601 to 660. Subprime is a credit score of 501 to 600, and then deep subprime is below 500 credit score. In this article, they compare a bad credit borrower to a perfect credit borrower. In other words, a deep subprime to a super prime. So the worst compared to the best. And the difference in their example is showing interest rates from 5.61 all the way up to 14.17%. Now, this is on a new car. And they're showing as an example a $30,000 loan over a 60-month term. That difference that you'll pay in interest between great credit and terrible credit is $9,000 over the life of the loan. That translates into about $150 more per month that someone is paying. Now, if you were to look at a used car, it's even worse. Great credit scores, they're suggesting the average APR for a used car is starting just over 7.4% interest. And that deep subprime, in other words, that 500 credit score or lower, is looking at an APR of greater than 21%. Now, if we were to compare those two numbers on a used auto loan, still using that $30,000 example, stretched over 5 years or 60 months, that difference is no longer $150 a month. That difference is now $340 a month. So you can see where having a credit score that suffers, that's lower, can cost you a tremendous amount more per month. And in this case, it equals over $20,000 more in interest fees over 5 years. Now, these different categories of credit also fall into the mortgage world. I want to use just a couple of examples based off of what Freddie Mac is saying as the average interest rate at the time of this recording, which is January 3rd. And what I want to share with you in this section is something that's called loan level price adjustments. There are all different reasons why interest rates could vary from person to person. It could be different from state to state. It could be different because of your property type. For instance, it's a slightly higher interest rate to buy a manufactured home or a condo than it is to buy, say, a single family home. And that is due to the loan level price adjustments. But the most significant impact, if you are financing your primary home, has to do with your credit score. Now, let me use an example of a conventional loan. That's the majority of mortgage loans that are originated. And let's suggest that we have 10% to put down and you're buying a $400,000 home. So you're financing $360,000. And I'm using an example over a 30-year term because that's where most people opt to go with their financing. It makes the payments more affordable than a 20-year or a 15-year loan. Although when you do shorten that mortgage term down to, say, 20 years or 15 years, it is typically a lower interest rate than a 30-year loan. But because we're financing hundreds of thousands of dollars, most people find it to be most comfortable over 30 years. Now, the likelihood of you holding on to this loan for 30 years is very low, but the payments are stretched out or amortized over 30 years. What I did was looked at the loan level price adjustments between a 780 credit score. Remember, I said 780 and higher is perfect. A 700 credit score, and also down to a 630 credit score. And friends, the impact is huge. When we compare a 780 credit score to a 630 credit score, that difference in payment is greater than $450 a month. Now, if we combine that extra interest charge to what you might be paying in extra interest charges on that car loan, this could equate between that interest on that car loan and the extra interest in the interest rate on your home loan to nearly $800 more a month. Now, I don't know about you, but I don't have $800 a month just sitting around waiting to be assigned to something. I think most of us feel stretched to the max right now with the cost of food, housing, insurance, and everything else that goes along. So when it comes to our decisions, what we have control over, where we're at in our life, I wanted to use these numbers to really drive home the point that credit absolutely affects your greater financial picture. It can help propel you by having you look on paper like somebody who's not a great risk and can qualify for lower interest rates. or it can really cost you and set you back because you're paying more in interest. So for instance, this housing payment example, I was using 7% as a going interest rate for a perfect credit score right now on a 30-year fixed rate conventional mortgage, where at 700, that interest rate could go up to 7.625. And if we go down to that 630 credit score, it's well above 8.5%. Now, I'm using interest rates that don't have any points or partial points, and I was just making these adjustments based off of the loan level price adjustment from the going interest rate that Freddie Mac is showing. This is not a commitment to lend. This is not a loan approval. I'm just using some basic numbers to show you that those higher credit score categories can benefit you year after year. Remember on that auto loan how I said you'll pay $20,400 more on a used car when we compare the highest credit score category to the lowest? Well, let's compare that highest credit category to this credit score if you had a 780 versus a 630. In this case, with a $360,000 loan, that difference on interest is $450 a month. And if you were to keep this loan over 30 years, friends, that equates to $162,000 in additional interest. That's crazy. And it's avoidable. This is why it's so important to keep an eye on your credit, to build a good credit history, but also be mindful of those decisions that you're making. If you're maxing out your credit cards, your credit scores can suffer. Not to mention all the interest that you're paying if you're carrying a balance month after month at likely 20-something% on those credit cards. So our goals when it comes to credit are the following. We want to look like we don't need to borrow money, so that way we can get approved for it. When you are desperate, you need something, and you come to a lender in need and with a lower credit score, unfortunately, you look like a greater risk and you're going to pay a higher interest rate or higher APR. So let's clean things up if there's some things to work on here. If you have maxed out credit cards or credit card balances that are greater than 30% of your limit, let's work on getting those down below 30% of what is available to you. So if you have a $1,000 limit, work on getting that balance down to below $300 for now and for always. Always keep it below 30%. And if you can get it below 10%, that's even better. If you have a tremendously high car payment or high interest on your car payment, do whatever it takes to get that payment gone. So that way you can move that money over into either paying off other debt or into savings so you can have a nice, huge, big down payment on your next car, or even better, pay cash for it. I'm telling you, nothing feels better than driving a paid off car. And then you can move that money that you were putting towards your car payment towards your next big goals. What are your goals for this year, for the coming years? Do you want to buy a home? Do you want to buy your next home? Do you want to build wealth through real estate? Do you want to have your credit cards, student loans, personal loans, and car loans all paid off? Would you love to be maxing out your 401k or your IRAs and saving towards your retirement? Would you love to have extra cash available each month so you can put that towards your travel fund or your dream bucket? All of these things are possible. I just saw a quote from Elon Musk that said, "It's easier to make $10,000 more than it is to save $10,000. And the moment you figure that out, the easier everything becomes." And it took me just a little while to ponder it. Not that it didn't hit me right away, but really to grasp the depth of what that statement means. See, most of us are in a position where we can take on a side hustle, we can start a business, we can work a second job. And $10,000 earned in 1 year, friends, that's $833 a month. So what could you do to create or generate or make $833 a month? Could you Uber? Could you do some DoorDash? Could you babysit or dog sit? Could you be a referee at some kids' sporting events over the weekends? What kind of side hustle or second job could you take on? If you could earn $20 an hour, you'd only need to work about 10 hours extra a week to earn this $10,000 a year. And what could that $10,000 do for your life and in your life? Could it finally get you out of credit card debt? Could it have your car paid off? Could it have your student loans getting closer to being eliminated? Could that be the down payment for your first home? Could your dream bucket start getting filled up so you could take that trip to Italy or get certified for scuba diving and go to some exotic Caribbean location and finally see the sights you're dreaming about? Start envisioning what you want for yourself. I hear so many people, and I've been guilty of it as well, just say general things about what they want. But I think you need to be very specific. You need to smell it and see it and taste it. You need to actually see yourself there, feel yourself immersed in that dream, in that vision. And then from that space, let's create a possibility. But I tell you what, in my life, my dreams were put on hold because I was servicing a tremendous amount of debt. Friends, I had 4 maxed out credit cards. I had a car payment that I could barely afford to pay each month. I had student loans, and I had no money in savings. Hear this now. Your net worth is not equivalent to your self-worth. So if you're not feeling excited about where you're starting this new year from, let's change that today. Declare something different, exciting, big for your life, maybe even bigger than what you might think is possible. I'd rather aim really, really high and come slightly short of it than aim low and actually accomplish it. Friends, we have a certain amount of time in our lives that we have a healthy, functioning body in which to make money. Our body and our mind someday is going to slip away and unfortunately betray us. So use it now. Use it wisely and use it well. God gifted you with unique and special talents. Share it with the world. Bring value to others. Get paid well for it. And then start using that money as a tool for you. For too many years, I was a slave to money, and it's a terrible feeling. It's a terrible way of being. So I use these examples to help show you the difference of having a great credit score and a low one. And I hope it is encouraging for you instead of discouraging to say, if I am where I am and I'm not really excited about it, let's get into action to make things happen. Pay those balances down. Pay your debt on time. Reduce your debt load so that you can start moving money over to the things that are really important to you, your bigger, larger goals. So you can check off some of those bucket lists. So you can start getting excited about being able to retire one day from the craziness of work life. So that you can check out for the kinds of vacations that you want. What is it that you want? And if you've been so far removed from your dreams for so long because you're just working to get by, I invite you to revisit and get very imaginative about what you want in and for your life. Because baby, you're worth it. Hey, I want to say thank you for starting the new year off with me, for being with me through this entire episode. If we haven't already connected, let's connect on social media at Credit Kristi. If you have any questions or an idea for an upcoming episode, I'd love to answer that for you. Send me an email at questions@creditkristi.com. And until next time, my friends, stay well.